Hi everyone, I'm Roger Herring. I am the Investor's Accountant. About 20 years ago I started a little firm called Investors Accounting LLC, and hey, that's what we do. We only work with real estate investors. I want to welcome you to this week's segment of Ask Roger. This is where you get to ask me a real estate, a tax, or a finance related question. Today's question comes from Gladys in Tampa, Florida. Gladys writes to me, "There was a vendor pitching cost segregation at our local RIA meetup. He made it sound like you would be crazy not to do it. What's he not telling us? There's got to be a downside." Well, Gladys, a vendor is going to give you all the ups and why you should use this product, but he's not going to give you any of the thumbs downs. So, first, let me explain cost segregation so we're all on the same sheet of music, and then I'll tell you all the great stuff about it, and then I'll tell you the not so great stuff about it. So let's go to the board. Okay, so cost segregation is where we take a building and let's just assume here's your building. And we're going to break out the components of the building. So let's just say that we bought this building for $1 million. Now, we're going to have some land with that building. Let's just call that $250,000. That's going to leave us with a depreciable basis of $750,000. Now, if we leave this basis at $750,000, when we depreciate it, if it's a commercial building, we're going to depreciate that thing over 39 years. If it's a residential building, we're going to do that over 27.5 years. That's a long time. Now, the idea of cost segregation is to take this building and break out the components. Now, let's think about it a minute. What's a building? The foundation, the floors, the walls, the roof. Pretty much everything else can be taken out of the building. The windows, the electrical, the plumbing, the fixtures, etc. All those things are components. And the idea of cost segregation is to break out the components and depreciate them over a shorter time. So, if we go in here and we take out the components, we can depreciate them for between 5 to 20 years. And hey, right now we've got this thing called bonus depreciation, which means we could write it all off right now. So let's just assume if we did a cost segregation study, here we've got, let's go to a new page, a depreciable basis of $750,000. Well, let's just say that we did a segregation study, and by the way, these cost between $3,000 to $5,000 to do, so you're only going to do this for a large building. So, the cost segregation study says we have $500,000 of building and we have $250,000 of components. Now, if we were depreciating this $750,000 over 39 years, that's $19,000 a year. If we take this $500,000, we still have to depreciate it over 39 years. That would be $13,000 a year. What do we do with this $250,000? We can take it right now. We can say, Roger, that's all well and good, but I invest in residential rental properties, single family, duplex, quads, whatever. Well, guess what? They just come out with commercially available software that will let you do a cost segregation study without having to have engineers come out. This works for 1 to 4 doors where the market value of the property is less than $500,000. So let's talk about a real example that I plugged into one of these softwares. Well, Roger, you say, that's all well and good, but we don't buy $1 million buildings. We buy residential rental properties, 1 to 4 doors. Got some good news for you. You can do cost segregation on anything 1 to 4 doors if the market value is less than $500,000. And you don't have to have a study. There is now software available that costs, instead of $3,000 to $7,000 per use, how about $500 to $700 per use? So you too can do cost segregation. And I got one of these softwares and I plugged in a sample property from right here in Atlanta where I live. So let's assume that we bought a property for $342,000. Now I know from the appraisal that the land value on that was $86,000. That's going to leave me a depreciable basis of $256,000. Now, I plugged this into the software, and the software told me that there are $51,000 worth of components that I can break out. So this is going to give me a depreciable basis of $205,000. Now, that $205,000, I'm going to take it over 27 and a half years. But what about this $51,000? I can use bonus depreciation and I can write it off this year. And guess what? If I am in the top tax bracket, 37%, that $51,000 is worth to me in real money $19,000. Pretty sweet. This is the molasses game. Of course, there's going to be some sulfur. That's what we're going to talk about next. So, like I said, now the sulfur. These guys that come to these RIA meetups, of course it's going to be the greatest thing since sliced bread. They're not going to give you the downside. There definitely is a downside to using cost segregation. First off, these great big deductions we were just talking about, most people cannot take them. You either have to qualify as a real estate professional, which means at least 750 hours spent in an owner's capacity in real estate, and more than half of your for-profit time must be spent as an owner in real estate. Okay? Once you qualify as a real estate pro, yeah, your deductibility is unlimited. If you don't qualify as a real estate pro, you're probably going to be capped out at $25,000 maximum deduction, depending on how much income you make. Because if you're over the limit, you may not be able to take anything at all. The other way to be able to take this large deduction is if you have passive income and you need to eat up with the deduction, then this passive loss that's created from the cost segregation can offset passive income. Okay? So, but most of the time, only a real estate professional can do this effectively. Alright, that's number one. Number two, it can come back to bite you in the butt later. Anytime you do cost segregation, or for that matter, anytime that you accelerate depreciation by using bonus depreciation, under the tax law, you are changing real property to personal property. That means when you sell the property, instead of being recaptured for depreciation purposes at 25%, the personal property is going to be recaptured as ordinary income. Ouch. So, if you're planning to sell this property in the short term, you might not want to do bonus depreciation or cost segregation. If you're planning to keep the property forever, go for it. When your kids inherit, you get a stepped up basis, everything goes back to zero. Third thing, if you're planning to 1031 the property, what you have done, again, is you've converted real property to personal property. Under the Tax Cuts and Jobs Act, 1031 now only applies to real property. So if you've done cost segregation and you enter into a 1031 arrangement, you are deferring the tax and you're deferring the recapture on the real property portion, but all the personal property, meaning everything that you've done cost segregation on or used bonus depreciation on, that's going to be recaptured immediately as ordinary income. So, eyes wide open, understand what your long-term strategy is before you do this. That was a lot for a little bit of time, and I know you guys probably have some questions. So, I'm happy to answer them. You can comment right here on this video. You can send an email to info@investorsaccounting.com. You can inbox me on Facebook. For that matter, you can send a DM on Instagram. I'll be happy to answer your question. And hey, if your question makes it onto a video, we'll let you know. Until the next time, guys, Roger out.